Hello and welcome to the Lending Coach forecast for housing and mortgage rates for 2023. I'm Tom Bonetto, the Lending Coach, and I look forward to sharing some of my thoughts and insights for the upcoming year. I know that housing is so important and vital to all of us, and we've seen home prices come down just a little bit after soaring to record highs. So what does 2023 have in store? Well, as we know with everything else, supply and demand will play a major role. And impacting demand will be interest rates. And interest rates have risen dramatically over the course of 2022, and we've seen demand really slow down. But interest rates towards the end of this year have started to show some signs of improvement, meaningful improvement actually. Now I think that's going to continue into 2023, and I'd like to show you why. As I've mentioned many times, interest rates, mortgage rates, and any long-term rate is going to be driven by inflation, because inflation erodes the buying power to the recipient of those fixed payments. So these monthly payments that the investors are receiving see the value of their dollar actually decrease. This buying power erodes faster when inflation's higher, so their only defense is to charge a higher interest rate. But as inflation comes down, mortgage rates come down. So let's take a look at this together. I've got some slides to share with you, and what I want to talk about first is how mortgage rates take their lead from inflation. In this slide, the blue line represents the 30-year mortgage rate, and the red line tracks the Consumer Price Index, or the core inflation rate. When inflation rises, mortgage rates rise. When inflation softens, mortgage rates soften, and when they're flat, mortgage rates go flat too. You can see that in August of 2021, inflation spiked, and mortgage rates started to respond. Now, we had a period that the Fed, although when the Federal Reserve raises interest rates, it doesn't directly affect mortgage rates. But in this case, they went ahead and bought mortgage-backed securities, and that was called quantitative easing, or QE. And during the period of QE, the Federal Reserve kept mortgage rates artificially low, right around 3%. And you can see that from January 2020 until January 2022. But inflation started to rise from these very low levels. The Fed told us that it was transitory, but mortgage rates didn't believe it and responded like they normally do. Why? Because the Fed kind of put a hold on it. The Fed was just buying enough mortgage bonds to tie them to a 3% mortgage rate. Now, once the Fed understood inflation wasn't transitory and they were kind of behind things, mortgage rates started to move higher. Once the Fed stopped buying mortgage-backed security, rates did what they always do. They followed inflation. So as inflation rose, mortgage rates rose. When inflation took a little bit of a reprieve, so did mortgage rates, and they moved lower with inflation. Then inflation started to move up, and sure enough, mortgage rates did that as well. And we've seen inflation come down, fortunately, at the end of 2022. Mortgage rates have also made some meaningful improvements, although they're significantly higher than when they were at the beginning of the year. The rate of inflation on the core CPI closing out 2022 was at 6% on a year-over-year basis. So let's take a look at the most recent data that we just received through November, and we'll actually get the December readings the second week in January of 2023. But if we take a look at each month's individual reading of inflation for the 12 most recent months, you add them up, and that's how you get 6% inflation. There's a little rounding and compounding there as well. But as we take a look moving forward, what we're going to do is start to replace these numbers. And here you can see December of 2021 will be replaced with new numbers for 2022. And you can see the more recent the data is, the more reduced inflationary pressures are. We know that the economy is slowing, and we know that we're heading for a recession if we're not in one already. So this should mean that we'll see lower monthly inflation readings. Replacing higher inflation readings will now be taken out of that equation. So when we get to December of 2022, we'll be replacing those numbers. It should be a lower number, and that should bring year-over-year inflation down. We should see the same thing in January, February, maybe not so much in March, but certainly April, May, and June, which is why I'm thinking that inflation makes a very meaningful improvement downward in the first half. In 2023, as we get rid of these high readings and replace them with the lower readings, that should help mortgage rates decline as well. Now, one other thing to take very important note of is the relationship between the U.S. 10-year Treasury bond, and that's illustrated in the blue line, and the 30-year fixed-rate mortgages, illustrated by the yellow line here in this chart. This compresses 35 years into one single visual, and you can clearly see that there's a very close relationship between both the 10-year Treasury and the 30-year fixed-rate mortgage. It's not day to day and it's not exact, but there's a kind of range that they gravitate towards, and it's about 175 to 200 basis points between each other. Put it in other words, 1.75% or 2% in difference. So in the past, if the 10-year Treasury were, let's say, somewhere in the range of 4, then mortgage rate should be somewhere in the range of 6. If the 10-year Treasury was at 5, mortgage rate should be somewhere in the range of 7, and this has been going on relatively consistently for 35 years until what we've seen towards the end of 22, when the difference between the two of them wasn't 175 to 200 basis points, but 300 basis points. That's an enormous change in the spread, so it was 3% higher. When you saw the 10-year Treasury a little over 4%, mortgage rates were a little over 7. So why did that happen? The normal ranges now 2%, and it's gone to 3. Why is that? What happened to change over the past 35 years? Well, you've got to remember that part of the value that goes into a mortgage is the servicing. So in this case, more value equals a lower rate. As bond prices go up, the yields go down. So helping the bond price of mortgage-backed securities goes up is something that's called mortgage servicing. See, very few of the investors hold their mortgages on fixed-rate products. That mortgage is sold in the secondary market to a loan servicing company. But what has to happen is someone still has to maintain the duties of collecting payments, telling borrowers that they're late or asking questions, taking the payment and making sure that taxes and insurance are paid. They have to service this mortgage effectively. Now, for doing that, for performing these tasks, the servicer receives a fee, so that adds value to the mortgage when it's sold. And you could calculate a good estimate of the fee based upon how long you hold that mortgage. Now, under normal conditions, mortgages last for years, several years, right? Probably 4, 5, 6, or 7 years for any regular mortgage. So you're going to collect that servicing fee for a long time. So that's a lot of value that's contained in that mortgage that's purchased by the loan servicer. And that added value helps the mortgage bond price, which helps bring the rate down. But now that rates are above 7%, everyone's thinking that these rates aren't going to last and they're going to come down. And actually, the money's agreeing with me on this. People now think that inflation will come down, which will bring down rates, and mortgage rates anticipated to drop, meaning services won't last long on these mortgages because people are going to pay them off or refinance them. They're not going to keep these 7% mortgages for a long time, and because of this, it sucked out all of the servicing value. The servicing value wasn't measured in years on a revenue stream like it normally is. It's now in months, making these revenue streams much smaller. Essentially, the mortgage servicing companies make less. And that component went into the bond prices, bringing them much lower, which meant rates were moving higher in relationship to the 10-year Treasury. Now, as the 10-year drops, and as we forecasted, it goes lower and lower, not only will mortgage rates drop, but they will drop faster as more servicing value gets added in. Because let's face it, a 6% mortgage is going to be on the books longer than a 7-year. So there's more servicing value. A 5% mortgage, more than a 6, and so on. And what we've already started to see as we get closer to the end of 2022, that spread was narrowing at the end of the year. The 10-year Treasury moved closer to 3.5, 3 5/8 rates. Mortgage rates have already started to move into the low 6s. So that spread, which was about a 300 basis point one, have already narrowed to something closer to about 250 or 200 points. So we're seeing this happen already, and we do think that the 10-year Treasury gets to around 3 or even less because of lower inflation, which means mortgage rates should follow suit. And if we get 3% rates, we should start to see some more normal servicing values. And that means that we should see mortgage rates closer to the 5% range around the spring of 2023. Now, there is a recession coming, although it may look like it's been staved off, or really has it been. The problem with knowing when you're in a recession is you get the National Bureau of Economic Research to declare that you're in one, but they don't typically do it until a year after a recession has actually started. You're typical in and out of it before they tell you you were. Doesn't really do you a lot of help, but what you can take a look at are some of the signs. Credit card debt. We are, after stimulus, living on credit cards for many people and also tapping into savings. These bumps here are the 3 stimulus packages in the graph that you see that helped people with their savings, but it's all been drained out, and we're even moving lower than pre-COVID levels. So people are keeping the lifestyle, but they're using credit cards and savings to maintain it. Even this has an expiration date and limitations. And when that hits a brick wall, the recession will become evident as spending will decrease and corporate profits will fall. Another near perfect predictor of recession is an inverted yield curve. And yield curve inversion is when you have your longer maturities that are supposed to have a higher rate of interest that actually yield a lower rate than their shorter term counterparts. It's a really reliable recessionary indicator. So when you take a look at the 10-year Treasury yield and you subtract it from the 3-month Treasury yield, it gives you what's called the yield spread. Now the 10 years is supposed to be much higher than the 3-month. So a bigger number minus a smaller number should be positive. But the yield on the 3-month Treasury is actually higher right now than it is on the 10-year. So when you take the 10-year minus the 3 months, you're now getting a negative number. And when that happens, the spread breaks underneath that 0% line that you see on the graph here. That's shown in 1980, 1992, 2002, 2008, and 2020. And we're very clearly negative currently. So we're either right on the cusp or about to head into a recession. As you can see, it's a pretty reliable indicator of recessions. But in the good news here, during recessions, mortgage rates actually decline. Now let's shift our focus to housing and the supply and demand component. The demand will come from household formations, and we've been chugging along with forming households at a rate of about 1.7 million a year. This is where you have a family member who's living at home, let's say, and one of the children comes of age and they move out and get their own place. You still have the same family unit, but now they're occupying an additional household. As I mentioned, we've been building at about 1.7 million for a while, but then we saw mortgage rates get to over 7%. Some of these people that were going to form households went into a bit of hibernation waiting for the rates to come down, so there's some kind of pent-up demand here. Now, at the same time, supply is softer. Builders have slowed things down a little bit. They're completing about 1.5 million homes a year. But yet there's about 100,000 homes per year that have to be replaced because of aging. As you can see by this chart, we're seeing only about 1.4 million homes come onto the market. And currently with hibernation, about 1.3 million households are being formed. So that's why the housing market has slowed now for activity. But when rates come back down, you're going to have household formations go back to its normal rate of about 1.7 million. And that very well might overwhelm the supply. And that should be very supportive of prices and builders. They've slowed things down. Permits have slowed. They learned their lesson from the housing crash from 2006 to 2009. But while people want to say there's a housing crash today, that's hardly the case. Look, in the last 10 years, prices are up 115%. In the last couple of years, they're up 39%. Now, even with rates at 7%, we've seen them come down a little bit, maybe about 2.5%, but not very much, even with the headwinds of much higher rates. And the reason for that is because inventory is still very tight and competing. Rents are still pretty high, but people want to buy homes. They're just hibernating for a bit. Remember, when rates come down, things will change. And another aspect that plays into all of this is affordability. And I think affordability really needs to be explained because when you do the math on this, it paints a very different picture than what the media is telling us. So let's assume last year you needed to buy a house and take out a mortgage of $400,000 to buy that home. So when you're buying that home, your mortgage is $400,000, and last year you got a rate around 3.5%. So here's your payment. Now things have changed this year, haven't they? So as we bring to the end of 2022, and we're about to enter 2023, home values this past year have gone up about 10%, which means to buy a similar type home this year, you need to spend 10% more or take out a mortgage 10% higher. That means you need to take out a mortgage of $440,000. And today's rates as we enter 2023 are closer to 6.5%, 6.25%. So that makes the affordability gap here quite large, about $900 a month. The problem with just looking at it is it only tells half the story, and the media won't tell you this. But look, a year ago, if you purchased this home, and Fannie and Freddie has good data on this, they'll tell you that not only was the qualifying income lower, but the average income from a household buying this home was about $9,000 a month. So two people making, call it about $500,000 a year or so. That's what you're looking at here. But ADP, the payroll company, they measured 250 million records, and they tell us if you kept your job, your income went up 7.6% this last year. If you switched jobs, it went up 15%, although more people obviously stayed than switched. So if you average it and weight it, it's about a 9% increase in income, which really mitigates a lot of the problem here. So that's not the main problem. But what also happened at the same time is that other things started to add up because we're paying now much more for gas and food and services. So, that's why the market's softer now and why it's slower and why people are hibernating. Their payments have gone up so much, while their income's gone up, it's not enough to cover the gap. So people are taking it a little slower. But what we have to start to do is think forward. Let's take a look at what's going to happen next year. Now, next year, what's going to happen to incomes? They're going up at 7.6% now, but let's be a little more conservative and say it only goes up 5%. Well, if they do, then your income will have gone up next year from $9,000 to $9,800 in 2022 to $10,300 next year. That means if you're making $1,300 more based on this increase than you were last year, but your payment's gone up $1,100 a month more, you've pretty much mitigated all the negativity of the market change. Taking a look at our housing forecast, you really do have to factor in inflation. And if it does retreat like it's showing very convincing signs of doing right now, and you couple that with a recession, it will drive mortgage rates down further. And certainly understandable to see mortgage rates close to the 5% range towards the middle of next year. That means you literally make 2023 affordability better than 2020. But you still have some tight inventory. And housing forecast shows low single-digit appreciation for most of the U.S. with a pickup in activity towards the later part of the year. And the reason for that is because of lower inflation. You've got a recession-like slowdown, you've got incomes increasing to help affordability, as we just showed, and a very tight inventory environment. Rents are still expensive and rising and not giving people much alternative. So we see appreciation for most of the U.S. and an increase in activity because people have to live somewhere. Now let's take a look at our mortgage rate forecast. And you see some of the headwinds. There's global quantitative tightening. Money's getting tighter. Lack of foreign central bank buying. We know that. So these can be difficult and things that we really have to take into account. And look, there's a lot of debt out there that needs to be financed as well. Our tailwinds, though, lower inflation, inventory potentially coming up later in the year, and that means sales will be driving down prices. Mortgage service value has increased, and there's likely going to be a recession, and that means rates will decline. I believe we'll see the 30-year fixed-rate mortgages move close to 5% during the first half of 2023, and the 10-year Treasury near 3% or lower, and I actually believe it could go lower than that. So I think there's good news ahead. We believe there's a reason to be optimistic as we look towards 2023, and I'd also like to wish you the best. I'm Tom Bonetto, the Lending Coach, and you can reach me at my website at lendingcoach.net and via email at tom@lendingcoach.net, or you can contact me via phone. In California, it's 909-375-3319, or in Arizona, 480-788-2658. Please do reach out to me because it would be my pleasure to help you any way I can. Thank you.